Hi, good to be back for. I think this is my last class, so it's a good class to be able to wrap up my ISM MBA. Even though I think I'm the last person to be signed up for it, the forum is a bit quiet. So, uh, oh well. But enjoying some of the topics, and this is something that I don't I kind of have a passion for, and I really like learning more about as far as investing and the market and stocks and all the different ways that you can make money in there, and the different strategies and the different point of views and perspectives and how people approach it. There's so many different ways. It's really interesting, and I think that's what makes it fun to talk to other traders or other portfolio managers of their approaches, because there's just so many different ways, and you can get very creative. I think that the market can become more of an art form than necessarily a scientific approach, and for me, I've tried to take that approach as well. So getting into the study, I think I'm going to bring an interesting perspective to this assignment when I analyze the study and hopefully bring some value. So to start, this is the Darden Capital Management case study for active investment management at ISM with you. And just to let's just give a little overview of the case. So the case is MBA students were tasked to manage an investment portfolio, and their strategy was to use fundamental analysis to invest in companies that appeared to be undervalued with potential upside, long-term upside. The team, after vigorous debate, settled on a few stocks: the Delphi Automotive Group, Groupon, Kellogg, and Kinross Gold Corp. There was a lot of debate over these stocks, one being Groupon, which they said that there was a lot of potential upside because it was undervalued in their eyes, but they also saw that it was presented a lot of risk due to potential volatility, versus Kellogg being more stable. And this is a debate about risk management, which any portfolio, anyone in the stock market, I think the number one thing they have to be talking about and considering is how do you manage risk. So volatile stocks and steady stocks can be good, depending on how you balance them and how much of a position you put in each stock. And then as a benchmark, the team used capital asset pricing model, and agreed the risk needed to be viewed throughout the entire portfolio versus individual stocks within portfolio, which these can offset each other. This is sometimes called a boxing a position, where you use a volatile position, often box it with a non-volatile position. And so it's interesting how they came up with these stocks, and from my point of view, I think there was a lot of incomplete. The case study was very incomplete as far as how to give an accurate analysis of presenting this to a board of saying, okay, these are the stocks that we decide on. And going into my analysis, I wanted to bring in more of a technical analysis point of view. This is one of my Bibles when it comes to trading stocks. It's technical analysis using multiple time frames by Brian Shannon. And to me, I'm a complete technical trader. I do very little fundamental analysis, and there's a lot of traders that do the same as me. I usually live more in small caps where fundamental analysis are less needed, where the stocks that we're referring to in this case study are large cap stocks, and these are real companies with the real financial statements and real PE ratios, where fundamental analysis can be more important. But I think one thing that could have been of value in this case study is really breaking down the charts, and I think the charts tell the real story. So Looking at the next slide, technical analysis. What I mean by that is a little quick overview is we're talking about support, resistant levels, trends, volume, moving averages, and times. And there's a lot of different indicators that traders use when they look at technical analysis. And technical analysis is strictly just looking at the chart and looking at the information you have on the chart to you then determine entry points, exit points, risk management levels, and potential profit targets. From the book that I just showed you, there's a lot of great information on there, but one quote that I wanted to put in here is technical analysis allows you to objectively measure supply and demand at work in the markets to gain an edge, then determine what might be the next short-term trend of the stock. And it can be over different time frames. That's why it's called using multiple time frames, because you can do intraday, monthly, weekly, or yearly. The technical analysis can be used across all price points, so it's universal in that regard. And price charts allow the trader to separate truth, price, from opinion by focusing on what people are actually doing with their money rather than what they may be saying. And that's where fundamental analysis can really be flawed, in the sense that it might already be priced into the stock. There might be insider knowledge that we don't know about. And so there's a lot more speculation when it comes to fundamental analysis that the strategy of this case study put all their weight on, versus technical analysis is really telling you the story of the stock. It's telling you the demand. It's telling you what the supply is. It's telling you where the people involved in the stock are, and if there's any interest in the stock, and then possible potential interest. It gives you a more concrete levels to enter, exit, to manage your risk and potential targets. It allows you to measure trend more easily. And just off this alone, you can play all types of stocks. And many traders, there's a book that I love called Market Wizards, which came out in the late 80s, and it interviewed some of the top traders, the most legendary Wall Street traders of the 60s, 70s, and 80s. And many of them who had some of the most successful hedge funds and still today are looking at icons on Wall Street. All of them use some form of technical analysis, and many of them use strictly technical analysis. Many do use fundamental analysis to be able, and that's critical in their strategy, but never ever would you find a trader that doesn't look at charts at all. And so I wanted to look at the history of each of these stocks and give my analysis from a technical analysis perspective, and show from my analysis, would these be good trades with the information, with what I have, strictly looking at the charts and not looking at anything related to the fundamental analysis. So I hope this brings an interesting perspective. Going with the first stock, I looked at Groupon. And the first slide is Groupon from 2012 to 2017 when the case study was taking point. So this is the information based off the chart that they had at the time that they were looking at potentially working into a position for the future. And there's a few things that I notice here. Here, my blue line that is curving right here is a 13 EMA, a 13 moving average. And for me, this is how I judge trend. And you look at nearly all of the 2012 year where I have the first blue arrow, it stays below that EMA, therefore trending consistently along that line. This is a very bearish indication, and there would be no reason to take a long position there. Until that point, and then we go into the next year and we get our first couple of points of resistance, and that is at a round number of 250 per share, and there's a double top right there. So automatically we have overhead supply there. So if I'm looking to long this position, 250 is a key number in my opinion, and that's something that we have to pay attention to. And nearly that entire next year of 2013, it trended in a bullish way, trending above the 13 EMA, until it gets to 2014, where you then go off right off that 250 line, come down, and with my second circle, you start to see some consolidation around 150. And this could be indicating either a potential support level, indicating that we are going to make our way up towards that resistance and start creating a channel, or it's going to break down, and therefore the supply of the interest and the demand of the stock is not enough to push it up towards a higher direction. And then we go into the next few years, coming in 2017, and it seems to never be able to get close to the 150. You have 150 level. It bases around $50, and that is your current your current support zone. And now looking at this chart and then also I have circles here at the very bottom where I have a bunch of red bars at the very bottom of the chart. This indicates volume, and it seems like many times during the earnings reports, all these circles here at the bottom where these red bars are volume indicators, and it indicates there is a trend where Groupon's earnings report has a sell-off, meaning there is a negative response to almost nearly most of the earnings reports. So that is a bearish indicator for me. Everything about this chart seems bearish to me. And yes, I would argue it's undersold, and there is a potential for upside, but there's key resistant levels above 150 and 250. There is no indication of trend at this moment. I think that there's nothing unless there is some a news catalyst that is going to give a reason why people would want to be interested in this stock, I would not be working in this position at this moment. I think that there would be too much speculation, and as the report indicates, that this is a very volatile stock. So going into the next slide, what happened? So the green bar is then 2017 and to present. And just based off my technical analysis, I think I would have saved ourselves some headache, because actually it eventually breaks that 50 support level and is now in it continues the downtrend, which continues its bearish non-interests. And even in 2020, the volume was quite large, and there was no upside to it. So this would have been a bad trade. From a technical standpoint, there was nothing in the chart that indicated to you that it was going to go higher, besides it being just simply oversold, which I don't think is enough to validate a position in a portfolio. We have a saying in trading, look left to predict right. If you look left, I think it showed that the prediction of right was there, and it was too uncertain. Moving on to Kellogg. Kellogg was a much more interesting technical analysis. So going into my circles of support and resistance that hit those red lines, one thing Kellogg was able to do is that it works in a channel between $60 and $70, which whole number and half dollar price points in stock market are psychologically important, and there's something to pay attention to. And particularly when a stock holds those, there's self-fulfilling prophecies where majority of the players in the market are paying attention to those numbers, and this is why support and resistance levels are so powerful, because they're self-fulfilling prophecies. And you see here, coming to 2012, it trends up. 2012, 2013, you have a couple of points of support. It does resistance, support, and then coming into after 2015, coming into 2016, it breaks that resistance, and we have a great push up to all-time highs in 2016. So this stock proves that it has the ability to have upward momentum when it breaks key support levels, and it has the ability to hold key support levels. Many times stocks don't necessarily respect support and resistance levels, which they become much more harder to read. Then you have a downtrending channel, And from that point in 2017, it then once again at the very end of 2017, it hits that 60 price point and holds that trend and holds that price point. So again, respecting that level. So off the technical analysis point of view, even though it is downtrending, it is coming back and once again respecting the $60 price point. So for me, this does have a potential for upward, for uptrend, for upside. If I was going to work into position, I would want to get as close to the $60 point, $60 per share, because that gives me my best risk reward. If as my game plan would be to work into that position, and if it broke the $60 support, I would immediately exit that position, because therefore we now have a new resistance point, and that would be $60. Support, when support is broken, this becomes your new resistance, aka a ton of overhead supply, which would sell into that, push towards it. So that is very bearish. This bouncing off of that, you might be you're taking more of a risk the farther you work into position from $60. But this would be something that I would look towards. That part of the, just from a technical point of view, that I would agree with. Now going forward, how did it play out from 2017 to present? Unfortunately, this one was an incredibly volatile stock. So their analysis of it being a steady stock was completely opposite of what Groupon. If we looked back on the Groupon stock, it actually was not volatile at all and just remained to go downtrending point by point. Where in Kellogg, there may have been some fundamental catalysts for his news or something in the industry in general that is causing all of this volatility. But from 2017 to present, this stock is an absolute mess. It has huge swings. It goes back up to that 70 price point, back down to the 60. It breaks out of that 70 and then just comes straight back down in 2019. And I mean, this is a wild swing in standard deviations. This would have been a headache. The second we get, Groupon. So far the analysis is Groupon had no indication of it being going to be bullish, and we were right on that. And unfortunately, Kellogg did have what possible technical analysis said there was potential, but unfortunately, no one is smarter than the market, and you have to have risk management a part of your portfolio, and when you work in positions, and Kellogg would have been a headache. And so far the portfolio is not looking good. Moving on to the next slide, gold. Once again, this one is not a good-looking chart. We have continuous downtrending, majority of it existing under the 13 EMA. We have a couple of points of, it's hard to find support and resistance. You have some at $6 and you have some support at $3. And one of the big red flags for me on this one is the price per share. Generally, stocks that are priced below $10 or below, there is a reason why they're down here. There's a reason why they're not valued more than that. There is something either that the stock is just, there's not enough demand there. There's fundamentally something flawed. It's not the right industry. So right away, if I'm looking at a portfolio, I think I would stay away from long-term real companies. I would stay away from stocks from $10 and below. Unless you know how to trade those. Where I live in small cap land, where all of the stocks that I trade are generally $10 and below, and the way you trade them are much different than you would in large cap stocks with higher price points. So I think that you're not staying consistent in the portfolio when you're going to price points per share to this low. And so for me, I would have stayed away from this completely. It's a commodity stock, meaning it's gold. So again, I don't know if this would have been the best decision. Going into the next slide of, okay, how did it perform from 2017 and beyond? it actually performed pretty well. From a technical standpoint, it did support some support and resistances. Coming into 2020, which was probably considered one of the most insane stock market in history, the volatility was unprecedented. This one would have been, again, very hard to predict. It was a slow mover. And so, again, I don't know if I would have stayed by it because of the price point. So it's kind of a toss-up. Which, if you're in portfolio management, I don't think you want to go into toss-up categories. At that point, you're just gambling. And so let's go to the next slide and look at the SPY from 2012 to present. And you can see some price points of volatility, as you can see in 2020, where that sell-off and the rebound is because of the coronavirus. That's something that no one can predict. So there is nothing that we can do about that. But if you look at this chart, and we looked at the charts from the previous stock, generally 3 out of 4 stocks follow the SPY or the overall market. And really none of these stocks that they choose for these portfolio followed that trend. And so that's also another red flag for me. And to note, the other stock that we were looking at, the automotive stock, that went through a couple of mergers. So that actually, I tried to look up their charts, and there really was no accurate information, and I didn't really want to talk about a stock that merged and changed their ticker, and they're kind of a complete company. And so that's another problem, is that one of their tickers, one of the stocks that they went through a couple of mergers, which are also a toss-up. Sometimes the market reacts good to them, and sometimes they don't. Sometimes the price is already worked into the merger, and sometimes it's not. So overall, I think that it was a poor selection of stocks. And really, if we look at the result of the from 2017 to present, if they actually did work into this portfolio, that it was a poor decision. I think the technical analysis is something that every portfolio needs to look at, and so that's something with this case study I would have talked about. I would have talked. They didn't talk about anything when it comes to their entry points. They didn't talk about how much they're risking. They didn't talk about at what point would they get out. They didn't talk about if they were going to scale in positions. And so there is a lot of missing information when it comes to really analyzing when you're going to work into a position and build in a portfolio with something like this. I know that's the point of the case study, is to analyze it, but it's very incomplete. I think it would have done a lot of good to talk about the technical side of things. If I were there, I would have presented this knowledge and say, and I would have said, what part of the chart is telling you that this is going to have some sort of upward push to be profitable for a portfolio. I think that you have to be able to balance both. There is no good portfolio manager or nor good trader that does not have the ability to read a chart. Many don't, though, and as a technical trader, I only analyze charts, and it doesn't matter if you're looking at penny stocks, small cap, mid cap, large cap stocks. The chart tells a story. It tells you where the players are, where the volume is, where the overhead supply is, where the support zones are, and where you can get good risk reward. And so I thought this was an interesting case. I wouldn't have signed off on this portfolio, and I think there was a lot of things they could have improved on. Unfortunately, if someone took this portfolio, I think it would have been a headache. In the end, their projected percentages were not correct. And considering 2020 was an anomaly, it was a black swan in the market. Every portfolio had a disruption there, and so that would have been hard to also predict and deal with. The sell-off was extreme and violent. The bounce back was extreme. Many on Wall Street and many in their 401ks and in their own portfolios lost a lot of money. This is why I prefer day trading, because I like to sleep at night. I like to get in and out of my positions within the day, make my money, go home, go to the golf course and eat dinner, and not have to worry about these type of events in the market. Diversifying your portfolio is also important too. There's, like I said, there's so many strategies in the market. There's so many indicators. There's so many ways to interpret, and with technology and the up-to-date information that we have today, there's so many retail traders getting along into the market. So the liquidity in the market is like we've never seen before. So it's a constant moving target. It's constantly changing. So it'll be interesting to see where it goes right now. I think the market is really changing. I think it's become much more difficult, much more volatile. And so I think having savvy portfolio managers is going to be a demand. And I think for those that are not able to adapt to the market are going to perish. And those that can adapt well, they're going to be very successful. So interesting case study. This is the kind of stuff I really like talking about. So glad that this is for my last class. This is great. So hope you're doing well, and talk soon.